Hi everyone, welcome to Energy Insights. Today we again have a special episode for the gas market related data, and we will review the gas market review for the monthly report of March, and up to some extent data will be covered for the February 2026. Overall, we will divide our today's episode into two segments. In the first segment, we have to cover the special article given by the gas exporting countries forum report, and in the second segment we will cover the overall market overview for the month of March. So without any further wastage of time, let's start our segment 1, which is a small scale LNG. Normally we call it a virtual pipeline projects, so powering decentralized energy markets. So this is a very alternate to the pipeline, because the gas market is linked with the pipeline technology. So in areas where there are issues in terms of geography or in access, then the challenge of the gas comes in comparison of the oil. So that accessibility issue is normally being resolved through latest technology, that's the virtual LNG project, where the LNG is provided through bowser or tanks and regasify at the consumer end. So we will cover in our today's segment 1 of this episode that small LNG features. So the global gas market is undergoing a fundamental transition from the centralized pipeline system to flexible, decentralized energy distribution. At the center of this shift is small-scale LNG, which is redefining how natural gas is delivered to remote, off-grid and fragmented demand centers. Unlike traditional large-scale LNG infrastructure, the small-scale LNG operates through modular, mobile and intermodal logistics, transferring gas into the highly adaptable energy solution. With capacities ranging from 0.05 to 1 MPTA million ton per annum, small scale LNG enables supply to locations where the pipelines are either uneconomical or physically unfeasible, supporting applications such as the distributed power generation, industrial fuel switching, city gas networks, and LNG fuel transports. Two distinct business models underpin this ecosystem. Number one is the dedicated small scale change. These involve direct transport of LNG via small carriers to localized regasification terminals. Their strength lies in rapid deployment, lower upfront investment, and geographic flexibility, making them ideal for early stage market entry and remote energy access. However, the absence of scale economies results in a higher per unit transport cost and increased operational vulnerability. While the second point is the break bulk or virtual pipeline model. So this model leverages large LNG terminal as hubs, redistributing LNG via tank trucks and smaller vessels. It combines the cost efficiency of bulk LNG supply with the last mile delivery flexibility. Trucked LNG in particular has emerged as the dominant mode, functioning as a virtual pipeline capable of serving inland demand within a 200 to 600 kilometer economic radius, and even up to 900 kilometer even in certain cases. So market data highlights a strong momentum between 2015 to 2025. The global small scale LNG trade remained more than double to 2.1 million ton, driven by the rising demand for the marine bunkering, off-grid energy and industrial decarbonization. Despite this growth, the segment remains niche, accounting for only 0.5% of the total global LNG trade, indicating significant untapped potential. Regionally, Asia and Europe dominate demand, with countries like China leading through large-scale deployment of the LNG-powered heavy-duty transport and industrial applications. On the supply side, Southeast Asia, particularly our Far East Asia, particularly Malaysia and Indonesia, has emerged as a key export hub, supported by expanding small-scale infrastructure and bunkering capabilities. Complementing the small-scale LNG is a micro-scale LNG, which uses ISO containers to deliver gas in even smaller volumes. This model is critical for monetizing stranded gas and enabling energy access in isolated regions. further strengthening the concept of LNG as a fully flexible and demand energy system. So the strategic insight is that this small scale LNG and the micro scale LNG are not just niche logistics solutions, they represent structural evolution in gas markets, enabling producers to diversify demand and importance to enhance energy security for developing economies, particularly in Asia and Africa. These models provide a low capex, scalable pathway to energy access, industrial growth, and emission reduction without the long-term risk associated with the large infrastructure investment. So, in essence, small-scale LNG is transferring the natural gas from a rigid infrastructure-bound commodity into a dynamic distributed energy solution tailored for the next generation of the global energy system. This concludes our first session of today's episode. Now we have to dive into the overall gas market summary for the month of March. The global gas market report we will review, provided by the Gas Exporting Countries Forum. So we will review the monthly report. The March 2026 global gas market report highlights a transitional and highly segmented global gas landscape. While short-term demand is weakening in mature markets due to mild weather and strong renewable penetration, LNG trade is expanding rapidly and reaching record levels. At the same time, Europe is entering spring with structurally low storage levels, increasing its dependence on the global LNG supply chain. So, overall, we will break down this segment into the global gas consumption trends, then the production developments, LNG and pipeline trade flows, storage dynamics, and price momentum and market signals. So, starting from the gas consumption, global gas demand across major consuming regions increased by 1.5% year-on-year basis in January 2026, driven mainly by Asia, while Europe and North Africa showed a mix to weak trends. So, in the context of the European gas demand remains highly sensitive to weather conditions and renewable energy variability. In case of European Union, the February consumption remained 37 billion cubic meter, which a downward decrease of 4.4% year-on-year basis. Similarly, from the January to the February, total consumption remained 84 billion cubic meter, which showed an upward increase of 3.2% year-on-year basis. So the key drivers of the decline remain the mild temperature, reduced heating demand, and strong wind output displaced the gas. Overall, gas-fired power generation fell by around 9%. In case of country breakdown, the Germany consumption remained 9.5 BCM. Similarly, Italian consumption remained 6.8 BCM. France consumed 3.2 billion cubic meter, and the Spanish consumption remained 2.5 BCM. Europe gas demand no longer structurally falling or rising. It is becoming highly weather and renewable dependent with strong intra-regional divergence. In case of the United Kingdom, the February demand remained 6.5 billion cubic meter. And in the January to February period, consumption remained 14.8 billion cubic meter. Overall, the key drivers remain the residential demand increased by around 8.3% and the industrial demand by 22%. Strong wind output reduced the gas-fired generation. UK demand overall weaknesses observed, and this reflects both the economic slowdown and the energy transition pressure. Asia, in the Asian context, the Asia remains the long-term structural growth engine of the global gas demand. In case of the China, the December demand remained 41.5 billion cubic meter, which an upward increase of 10% on year-on-year basis. The key driver remained the industry expansion, coal to gas switching, and power sector growth. In the case of India, the January demand remained 6.1 billion cubic meter, which an increase in year-on-year basis of by around 5.4%. The fertilizers by 29% and city gas by 24% are the major shareholder of the Indian gas consumption for that period. In case of Japan, the February consumption remained 8.2 billion cubic meter, and the lower electricity demand due to the warm weather also decreased overall demand by around 7.4%. In case of South Korea, Demand also showed a downside when the February demand remained 5.7 billion cubic meter, which downside decreased 9.7% in the consumption. Asia is structurally growing, but short-term demand remains volatile due to the weather and policy cycles. In case of North America, the United States February demand remained 87 billion cubic meter, and from January to February it remained a 195 billion cubic meter, which a mild decrease of 2.3%. And the breakdown, the residential consumption decrease remained by 6.5%, commercial 7.6%, and industrial demand also showed a downside movement by 2.7%. So despite lower demand, gas still dominates the electricity by around 38% of the US power generation comes from the gas power plants. In case of Canada, the consumption remained for the January by 14 billion cubic meter, decline driven by the warm weather and weaker heating demand. On the production side, now from the consumption we are going towards the production. So on the consumption and the production side, the European production slightly showed a downside by around 0.4%. Structural decline continues due to mature basin depletion. In the case of United States, the production remain 87 billion cubic meter, and the US remains the single largest source of the global incremental supply, especially for LNG exports. In the Asia Pacific, the output remains 60 billion cubic meter. China continues moderate expansion. Global supply growth is now US led and LNG oriented, reinforcing US dominance in the marginally supply. On the gas trade, LNG imports, the global LNG imports remain 38.2 million tons, with an increase for the February and 12% year-on-year basis. LNG imports to the Europe remain 14 million ton, and LNG share in Europe supply remain 32%, while the pipe supply share remain 30%. Europe is now a dual importer dependent market, LNG plus pipeline. From the European supply balance, total demand remained 43.5 billion cubic meter, while LNG supply shared 13.9 billion cubic meter, and the pipeline imports provided 13.2 billion cubic meter. The storage withdrawals remain 11.5 billion cubic meter. So Europe is increasingly relying on storage flexibility plus LNG import as balancing mechanism. In LNG re-exports, the share remains 0.47, almost 0.5 million tons globally, and driven mainly by China. In the arbitrage conditions, the Asia-Europe LNG spreads remain $0.25 to $0.65 per MMBTU. Cargo flows remain anchored in Europe due to the stronger net pricing. In the gas storage context, the European storage remain almost 35% full, with the total 36 billion cubic meter. Last year it was 47 billion cubic meter. So storage contribution to supply is 27% in 2026, while the last year it was 33%. So Europe enters a refill season with historically low inventories, increasing LNG dependency. In case of Asia, the storage remain 12 BCM, which increase of 36% year-on-year basis, provides a stronger buffer against the price volatility and supply disruption. In the case of North America, storage remain 58 billion cubic meter, which is almost 43% of the total capacity. Balanced market structure supported by strong domestic production. In case of energy prices, the Europe TTF softened due to the mild weather and LNG inflows. The Asia GKM relatively remained stable for the month of March and February. In US, the Henry Hub remained low due to oversupply to the market. So the prices, almost average price for the March remained 16 to 19% per MMBTU for TTF. In case of GKM, it remained $15 per MMBTU, while the Henry Hub price remained around $3 per MMBTU. Strong fuel switching being observed between coal and gas. The LNG arbitrage constraints shaping the global flows, and weather remains a dominant short-term price driver. So the March 2026 gear market is defined by four structure forces. That's the demand divergence. Europe and US declining short-term consumption. Asia long-term growth engine remains intact. LNG dominance 38.2 million ton imports, and LNG is now globally balancing fuel. In the case of Europe, storage remain 35%, heavily reliance on for replenishment. In the LNG, the US LNG remained in the leadership position by production growth of 4.8%. So the global market is no longer regional; it is a fully interconnected through LNG, and in this system, weather drives demand, LNG drives balance, storage drives security, and the US drives supply. That's the new structure of the global gas market for the month of March 2023. Thank you for watching Energy Insights, and this concludes our today's episode. If you have found this analysis valuable, please like and subscribe the channel, and we will see you in the very next episode. Thanks again for watching Energy Insights.